Welcome to the deep dive. This is where we try to cut through all the noise, the fire hose of information hitting the tech markets and really boil it down to what you need to understand. Today, our mission is, well, it's to take a step back. We've done deep dives on specific companies, right? We've looked at Nebius, IREN, Navitas, EOS Energy, all crucial players. But today, we're tackling the big one, the fundamental question behind all this activity. We need to understand the massive forces, the structural drivers behind this huge global AI buildout. And that brings us to the core question, the one that's hanging over everyone, I think, from individual investors right up to, governments. Are we staring down the barrel of a massive AI bubble that's just waiting to pop? I mean, you see these numbers in companies throwing over $100 billion a year to infrastructure. You see these valuations. It's natural to be skeptical. It's necessary, really. Is this just 2000 all over again, but maybe with fancier GPUs this time?
Yeah, and that skepticism is totally healthy. There's so much noise, right? But my core argument here is pretty clear. No, definitely not. What we're seeing today, it's fundamentally different. This isn't some speculative frenzy based on hype. It's not FOMO driving this. This is a real tectonic, you could say, infrastructure revolution driven by absolute necessity. And that necessity, it really boils down to one single concept: compute.
Okay, compute. Let's unpack that because we hear it constantly. We kind of get that it means processing power, right? But in this context, this multi-trillion-dollar revolution context, what exactly is compute and why is it suddenly this incredibly scarce resource?
Right. So compute in this AI era, it's about the sheer raw horsepower you need to make modern AI work.
Hmm.
And it's really two big demands hitting at once. First, there's training. That's the colossal amount of power needed to actually build these huge foundational models, your GPT-4s, your llamas. This takes months sometimes, massive resources running flat out 24/7. Then there's inference. That's the power needed to run the models once they're trained. Every single time you type a prompt into ChatGPT or ask an LLM a question, that's inference. And both of these, training and inference, they're just generating this absolutely insatiable demand.
Okay, insatiable demand. But didn't we always have Moore's law sort of handling increasing demand?
Ah, Moore's law. Yeah, for decades, that was like the bedrock physics of the tech industry, wasn't it?
Yeah.
So predictable. It basically said the number of transistors you could cram onto a chip, which dictates its efficiency, its power would roughly double every 2 years.
Right, a predictable rhythm. Steady progress the whole economy could kind of plan around.
Yeah.
If you built a data center, you knew things would get twice as good in a couple of years.
Exactly. It kept things stable. But AI hasn't just bent that law, it's completely shattered it. And here's the critical breakdown, the mismatch. Chip efficiency, the actual hardware, it is still roughly doubling every 2 years, still following that Moore's law track. But the demand for compute, specifically for AI training, that's exploding. It's growing 4.5 times every single year.
Whoa, hang on, let me get this straight. The tech doubles every 2 years,
Mhm.
but the need for it is more than quadrupling every year.
Yep, you got it.
So you're constantly falling behind. The gap just gets wider and wider.
Precisely. Demand is just radically outstripping the underlying supply improvement rate by more than double year after year. That's why we have this massive structural shortage. That's why we call it the compute crisis. And the only way to bridge that gap right now, it's brute force. Spend unbelievable amounts of money. Buy more chips, install them, power them up. You simply can't wait for the efficiency gains to catch up anymore. They won't.
Okay, that paints a picture. Can you give us a sense of the scale? How fast is this performance leap actually happening?
Okay, killer stat time. Let's look at NVIDIA. They're the leaders right now, no question. Back in 2016, their top chip, the Pascal architecture, delivered about 19 TFLOPS. That's trillions of floating point operations per second, the basic speed metric for AI.
19. Okay, I remember Pascal. Seemed fast then.
Right. Now, fast forward to today. Their newest architecture, Blackwell, it's projected to deliver 20,000 TFLOPS.
Wait, from 19 to 20,000 in 8 years?
20,000, so 1,000x increase in 8 years.
That's not just progress. That's like a different species of technology.
Exactly. It shatters any historical comparison. Think about the shift from steam to electricity or the invention of the microchip itself. This is faster. It's like going from, I don't know, a bicycle to a Saturn V rocket in less than a decade. The velocity is just staggering.
Okay, so the big takeaway here, compute isn't just some tech spec anymore. It's fundamentally becoming the most valuable commodity of the 21st century. It's appreciating like crazy.
That's the perfect way to frame it. It's the bedrock.
If you don't have compute, you basically can't play in the next economic game.
You can't compete. Full stop. And the market, well, it definitely reflects that scarcity.
Right, which leads us to the really fascinating part. We've got this, like, desperate, accelerating need for compute power that's outrunning supply. But this compute isn't virtual, right? It has to physically exist somewhere. It needs buildings, power, cooling. So what happens when you try to actually build the infrastructure to house 1,000 times more processing power in the real world?
Yeah, that's where you slam right into the physical bottlenecks. It's unavoidable. If compute is the new oil, like you said, then you need the new oil fields, the new refineries, the pipelines, and those are the data centers. What we're seeing is, honestly, it's like a modern gold rush. But instead of digging for gold, everyone's pouring concrete for these massive data centers. They are the physical factories of this AI revolution.
And given that structural shortage you laid out, this isn't just about adding a few server racks here and there. The scale of investment must be different.
Oh, completely different. It dwarfs previous infrastructure cycles. Just to meet the current demand, the demand that's already locked in, analysts estimate the world needs to invest something like $500 billion
Half a trillion.
per year, every single year,
Mm.
until 2030, just to build the physical boxes to put the machines in.
Half a trillion a year, just for the buildings. These specialized air-conditioned concrete boxes, what does that kind of sudden, massive demand do to the market, like the construction market?
It throws everything into overdrive. You see massive acceleration, massive inflation all through the supply chain, the overall global data center market. It's forecast to hit over $900 billion by 2028. That's growing at like a 23% compound annual growth rate.
Oh, it's 2% CAGR on nearly $1 trillion. That's huge growth.
It is. But get this.
Yeah.
If you zoom in on just the specialized servers for AI, the high-performance stuff, that segment's growing even faster. We're talking 41% CAGR.
Wow. 41%.
Yeah, that kind of acceleration puts immense pressure on everything. Costs go up, capacity gets squeezed. Just look at construction costs. Spending on building data centers is up a staggering 322% compared to just 4 years ago.
322%.
Yep. And think about why. Scarce specialized labor, huge demand for things like advanced cooling systems, trying to get permits pushed through quickly. It all adds up. And remember that 322% increase. That's just for the building, the shell, the cooling, the power hookups. It doesn't include a single chip, not one server.
That jump, 322%, that feels like the clearest signal you could get. Demand is just completely overwhelming supply. Priorities have shifted.
Massively shifted. It's actually forcing this historic pivot in economic priorities. You can see it in the construction numbers. For the first time ever, certainly in big markets like the U.S., the total value of data centers currently under construction. It's on track to actually exceed the value of traditional office buildings being built.
No way more money going into data centers than office towers.
That's the trend. We are literally watching the economy reconfigure itself in real time, moving away from yesterday's commercial real estate focus towards the fundamental infrastructure needed for AI.
Okay, so compute crisis leads to data center boom, which leads to skyrocketing construction costs. But data centers, notoriously power hungry, right? All that compute, 247, generates incredible heat, needs incredible amounts of electricity. That has got to be the ultimate constraint.
It is. It absolutely is the ultimate choke point. And frankly, that's why just focusing on the GPUs is missing the bigger picture. The real long-term bottleneck isn't silicon, it's gigawatts, energy for compute. That's the real oil of the 21st century. If you can't power the thing, the compute is useless.
So what does this power crunch look like on a global scale? How big is this problem?
The forecasts are, well, they're pretty sobering. Demand for power just from AI data centers is projected to basically quadruple over the next 10 years globally. By 2035, AI data centers alone are expected to consume around 1,600 terawatt hours of electricity.
1,600 terawatt hours. How much is that in context?
That works out to about 4.4% of all global electricity generation, nearly 1/20th of the entire planet's energy budget, just for AI.
Wow. Almost 5% of global electricity. And what about here in the U.S.?
The impact is just as dramatic, maybe more immediate. U.S. data center power consumption is also forecast to quadruple, but even sooner by 2030. By then, they'll be using as much electricity as roughly 60 million American homes combined.
60 million homes worth of power just for data centers. Our current grid wasn't built for that, was it?
Not even close. A lot of the grid infrastructure is decades old. It simply wasn't designed for that kind of massive, constant, heavy power draw that AI demands. It requires huge upgrades, expensive upgrades.
This brings up a practical point then. If these big AI models need months of absolutely uninterrupted training, they can't afford downtime. How do intermittent renewables like solar and wind fit into that? They aren't always on.
That's a critical challenge. They can't reliably provide that constant 2047 baseload power on their own, which is exactly why you're seeing nuclear power getting serious consideration again.
Ah, nuclear, because it's always on.
Exactly. Nuclear offers that essential 24/7 stable, dense power source. It perfectly matches the energy profile AI data centers need: constant, heavy draw. Renewables are fantastic, obviously, but for a multi-hundred-million-dollar training run that takes 6 months, you can't risk an interruption. The cost of failure is just too immense. Nuclear guarantees that uptime.
So alongside maybe more nuclear, we're also seeing a big push for energy storage, right? To kind of smooth things out.
Precisely. Energy storage becomes strategically vital. Not just nice to have for green reasons,
Yeah.
but mission critical for grid stability. And you see companies making big moves here. Look at Tesla, for instance. They're moving way beyond just cars now. They're signing these huge deals for their mega pack battery systems. These are utility-scale batteries designed to stabilize the grid.
Like buffering the power supply?
Yeah, exactly. They just signed a massive, like, $2.7 billion deal with Georgia Power. That's for 500 megawatts of energy storage. And another big one in Shanghai, over $500 million. These huge battery farms are being built specifically to manage grid fluctuations, store excess power, and ensure that these AI factories can keep running 2047. Even if the grid gets shaky, it minimizes the risk of crippling outages.
That's a fascinating link. The AI compute race is literally reshaping energy production and storage globally. Okay, let's talk money. Who's actually writing these massive checks, these hundreds of billions of dollars?
Right, spenders. The main players driving this are the ones you'd expect, the hyperscalers. We're talking Microsoft, Amazon, Google, and Meta.
The big four.
The big four. And they are locked in what you can only describe as an existential arms race. The spending figures are just monumental. Get this. In just the second quarter of 2025, one single quarter, those four companies together spent $88.25 billion on capital expenditures. CapEx.
88 billion.
In 3 months. $88 billion. And that was up 67% from the same quarter the year before.
A 67% increase on spending that was already in the tens of billions. For companies that big, that growth rate is just wild.
Oh, it really is. It's basically a blank check approach. The driving force is pure fear of being left behind. Microsoft has already said they're putting over $100 billion into CapEx this year alone. Amazon and Google are right there with them, spending at a similar, absolutely frantic pace.
$100 billion from Microsoft just this year.
And you heard Mark Zuckerberg at Meta, right? He basically said they'll spend whatever it takes. He'd rather spend hundreds of billions now than risk falling behind in the race for superintelligence. They all see it the same way. This is winner take all. If you don't secure the compute foundation now, you're essentially giving up the next decade of competitive advantage across every single industry AI touches.
Okay, but hold on. If the hyperscalers are dropping $100 billion a year each, why are we also seeing this explosion of new specialized companies, these neoclouds? And why are giants like Microsoft and Meta paying them billions of dollars? Shouldn't the hyperscalers have enough capacity if they're spending that much internally?
That's maybe the single clearest piece of evidence proving just how deep this structural shortage runs. Even these companies, the ones with the biggest balance sheets on the planet, they literally cannot build fast enough to meet their own internal demand, let alone serve external customers.
They can't keep up with themselves.
Nope. So these neoclouds, companies like CoreWeave, they exist precisely to fill that gap. They specialize in offering super high-performance AI compute, usually using the absolute latest, most powerful chips. And critically, they can often get those chips and get them online faster than the giant hyperscalers can manage with their own massive buildouts.
So the demand is so intense that even a $100 billion internal budget isn't enough. There's still room, billion-dollar room, for smaller, specialized players.
Exactly, and the size of the deals proves the desperation. Look at Meta. Huge internal capacity, right? But they still signed a multi-year deal with CoreWeave worth up to $14.2 billion.
$14 billion to rent compute capacity.
Yep. Vital for training their next-gen models, like Llama. Or look at Nebius, we talked about them before. They landed a deal with Microsoft worth at least $17.4 billion through 2031.
$17 billion for Microsoft.
These are massive multi-year commitments. They shout loud and clear. The hyperscalers are capacity constrained. They have to rely on outside help to get the compute power they need.
That really paints a picture of extreme scarcity. Okay, so if you can't build it all yourself and you can't even buy enough from specialized partners, what's left? Is there a shortcut? We've heard some surprising stories involving Bitcoin miners.
Yeah, this is one of the most fascinating sort of tactical responses to the crisis. It really highlights the desperation created by both the compute crisis and that gigawatt crisis we talked about. Big tech companies are now actively partnering with or even acquiring former Bitcoin mining operations.
Why miners? What do they have that big tech wants?
Two absolutely critical assets that are incredibly hard to get quickly otherwise. First, existing data center facilities, often already built, already operational, and frequently located strategically near cheap power sources. Second, and this is the real prize, pre-negotiated massive power contracts, locked-in agreements for huge amounts of electricity.
Ah, the power contracts. That's the golden ticket, isn't it? Getting the permits and the utility connection for a new massive facility can take years.
Years. It's the ultimate bottleneck. So by partnering with these former miners, tech companies can essentially bypass all that regulatory delay, all that grid planning. It's a shortcut. Google's been really active here. They dropped $3.2 billion to become the biggest shareholder in TeraWulf. TeraWulf was a miner. Now they're pivoting hard to hosting AI workloads.
$3.2 billion, just for TeraWulf.
And they also signed a separate $3 billion 10-year deal with another former miner, Cipher Mining, specifically for AI data center capacity. It's all about speed, getting quick, stable access to physical infrastructure, and, most importantly, that guaranteed energy flow without waiting years for new stuff to get built.
Okay, but doesn't that feel a bit risky? You're jumping from one arguably speculative market, crypto, into building the foundation for another potentially hyped market, AI. And you're using infrastructure that was maybe built fast and cheap for mining.
That's a really fair point. There's definitely a risk calculation happening there, but I think the calculus for them is pretty straightforward right now. The immediate, overwhelming need for power capacity and physical space far outweighs the potential risks of using that legacy infrastructure. Remember, they're not usually buying the old mining hardware. They're buying the building, the cooling systems, and crucially, those existing huge utility hookups and power agreements.
The power agreements.
Those power contracts are so scarce, so valuable right now, that grabbing them, even if they come attached to older facilities, is seen as a necessary strategic move. It makes sense in the short to medium term, given the sheer urgency.
Okay, so we've got the structural compute shortage, we've got the physical bottlenecks of data centers and power, we've got astronomical spending from the world's biggest companies, even using creative shortcuts like partnering with miners. Which brings us right back to the core question. $100 billion a year in CapEx from just one company. $500 billion needed globally each year for buildings, spending up 67% year over year. How can you look at those numbers, that frenzy, and say with conviction, this is not a bubble? How is this not like the dot-com crash?
Yeah, I get it. The comparison to 2000 is completely understandable. That era was defined by hype, by speculation, by promises that never materialize. But when you really drill down, the situation today is profoundly different, structurally different. I see 4 key reasons why this isn't a bubble, why it's durable.
Okay, let's hear them. Point 1.
Point 1, profitability and leadership. Who is leading this charge? It's the world's largest, most profitable corporations: Microsoft, Google, Amazon, Meta. These companies have incredibly strong, diversified balance sheets. They have massive, highly profitable existing businesses that are funding this AI transition.
Right, unlike 2000.
Exactly, the dot-com boom. That was largely fueled by startups burning through venture capital, chasing eyeballs and clicks, often with zero revenue, let alone profit. Many went bust before making a sustainable dime. Today, the companies laying this foundation are financial fortresses. That's a fundamental difference.
Okay, solid point. The foundation is built by giants, not startups on shaky ground. What's point 2?
Point 2 follows directly. The funding mechanism. How is this historic build-out being paid for? It's being funded organically.
Right.
Straight out of cash generated by their core businesses. They're incredibly profitable operations. It's not reliant on loading up on debt or risky equity offerings.
They're paying cash.
Pretty much. Look at Microsoft again. Over the last 3 years, they ramped up CapEx by 170%. That's a $40 billion increase in spending.
$40 billion more per year.
Yeah. But get this. In that exact same 3-year period, they were generating so much cash, they actually reduced their long-term debt by over $6 billion.
They spent $40 billion more and still paid down debt.
Because the cash flow is just immense. In fiscal year 2025 alone, Microsoft generated $136 billion in cash from operations.
$136 billion in 1 year.
Just think about that number.
Yep.
That's more cash in a single year than the total annual revenue of many Fortune 100 companies combined. They are literally paying for this generational infrastructure revolution out of pocket while strengthening their balance sheet. That financial durability just didn't exist in 2000.
That's a killer point.
Okay.
Self-funding a revolution while cleaning up the balance sheet totally flicks the risk profile from 2000.
Okay, point three. Point three. Valuations. Yes, tech valuations are high today, but compare them to the dot-com peak. It's night and day. Back then, valuations were completely untethered from reality, based on hype, potential, clicks, anything but actual earnings. Today, the market's more rational. If you look at the S&P 500's forward price-to-earnings ratio, the PE ratio, it tells you how much the market's willing to pay for each dollar of expected future earnings.
Right, a measure of market expectation versus actual profit.
Exactly. Today's forward PE for the S&P 500 is nearly half what it was at the peak in 2000.
Half. So investors are paying less than half as much for future earnings compared to the dot-com peak.
Broadly speaking, yes. And for many of these leading tech companies, even with high stock prices, their forward PE ratios are actually staying stable or even decreasing.
How? Because earnings are growing so fast?
Precisely. Their earnings growth is so explosive that it's keeping pace with or even outpacing the stock price increases. The earnings are justifying the valuations in a way they simply didn't back then. There's a fundamental grounding this time.
So the value isn't just based on hope. It's anchored to massive real revenue from cloud, from software, now being supercharged by AI.
Exactly. Which leads perfectly into the final, maybe the most crucial point. Point 4. Real contractual backlogs.
Okay, what does that mean?
It means the demand driving this spending isn't just vague projections or analyst hype. It's based on actual signed, legally binding sales contracts. These hyperscalers aren't building data centers on a whim, hoping customers will show up. They're building them to fulfill massive orders they already have in hand.
They have the customers lined up already.
Absolutely. Take Oracle, a huge cloud player, heavily invested in AI now. They recently reported their RPO remaining performance obligations. That's the value of signed contracts for future services they have to deliver.
And that number was?
455 billion.
With a B.
Billion dollars in locked-in future sales, much of it driven by demand for AI compute. That kind of backlog validates every penny of their CapEx spending.
Wow, okay. That's not speculation, that's booked business.
It is. And it's not just the giants. Look at CoreWeave, one of those specialized neoclouds. Their revenue backlog jumped 85% in just one quarter, reaching $30.1 billion.
$30 billion for a smaller player.
Signed, sealed, delivered contracts from customers desperate for compute who have already committed the money. This is concrete demand. It's an economic necessity being met, not a speculative bet.
Okay, let me try and summarize this then for the listener. We have a structural compute shortage demand just crushing supply growth.
Yeah.
This forces a massive infrastructure build-out data centers power. But crucially, this build-out isn't speculative. It's led by the world's most profitable companies. They're funding it with cash, not debt, while actually improving their balance sheets. Valuations, while high, are far more grounded in actual earnings than in 2000. And underpinning it all, hundreds of billions of dollars in real signed contracts from customers who need this capacity. That really does sound like laying the foundation for a new economy, not inflating a bubble.
That's exactly the takeaway. You look at the evidence, the supply-demand gap, the self-funding, the real contracts, it points overwhelmingly towards this being a fundamental, necessary, and financially durable infrastructure revolution. It's the bedrock for the next economic era.
That puts those huge spending numbers in a much clearer and, frankly, more reassuring light.
Right.
But you teased something earlier. You said all of this, the compute, the data centers, the power, it's all just for phase one. What's next? And why does that make the compute demand even bigger?
Yes. The next frontier. This is where it gets even more mind-bending, potentially. Everything we've discussed today, all that compute, all those gigawatts, all those billions, that's almost entirely focused on what we can call phase one, thought AI.
Thought AI.
Meaning
Digital intelligence. AI that operates purely in the digital realm. Analyzing data, processing information, generating text or images, making predictions based on numbers. It lives on screens, in servers. The massive shift, the one that will unlock vastly greater compute demand, is the transition to physical AI.
Physical AI,
Okay.
like robots, self-driving cars. Exactly. Systems that have to interact with the messy, unpredictable physical world in real time. Next-gen robotics, truly autonomous vehicles, AI guiding surgical tools, things that need to perceive, understand, decide, and act in three-dimensional space.
Okay, I can immediately see why that's different. Digital AI mostly pushes pixels, right? Physical AI has to deal with physics. Gravity, friction, latency, surprises.
All of it. Think about what a self-driving car needs to do. It needs to constantly process data from cameras, LiDAR, or radar, that's perception. It needs to build a real-time model of the world around it, predicting what other cars or pedestrians might do. It needs to make split-second decisions based on physics and safety. And then it needs to translate those decisions into precise actions, steering, braking, accelerating.
That sounds exponentially more complex than generating text.
Orders of magnitude more complex. It requires vastly more processing power just for the perception piece alone. Then add real-time physics modeling, constant micro-decision-making, controlling physical actuators. If thought AI needs immense compute just to process data, physical AI needs astronomical compute to navigate and interact with reality safely and effectively.
And the big players, they see this coming.
Oh, absolutely. It's the clear next step. Look at Tesla's Master Plan Part 4, which they just talked about. It's basically a blueprint for this. Their stated focus is explicitly on bringing AI into the physical world through robots, through vehicles. They know that's the next wave. So, yeah, here's the punchline, the real hook for the future. If you think the demand for compute for data centers for power is massive now, when AI is mostly just thinking behind a screen, just wait. Wait until AI needs to power a physical body, to see, move, interact, react in the real world, processing an infinitely complex and changing environment every millisecond. That's when the truly greatest demand for compute will hit. We haven't seen anything yet.
Wow, okay. That really frames the scale of this. Today was about building the brain, understanding the infrastructure needed, proving it's financially viable, showing it's not just hype. But the next chapter, what happens when that brain gets a body? It needs to power potentially every machine, every vehicle, everything that moves. That is definitely the question to ponder, and maybe the subject for our next deep dive. Thanks for joining us on the deep dive today. We'll catch you next time.